just say that there are speculation, and there is speculation and there is investing. And I really ascribe to the investing philosophy. And so that at a high level encapsulates what this book is about. And so I walk through 7 chapters that distill what normal is, and then why I feel that normal is wrong, for lack of a better word. So I believe that the purpose of tonight, or the format of tonight, will be a debate, or at least a panel discussion going through some of the topics that I espouse in this book. I don't know how many folks on the call have read the book, but those that have, I encourage you to pepper me with questions or thoughts. Feel free to give me why, a rant on why I'm wrong, or just basically ask any questions on, where my philosophy has taken me and how I've gotten there.
All right. And I guess before we jump into things, I'll mention, of course, Financial Analyst Society of Puerto Rico is, we're not making any investment recommendations here. This is a discussion, and we'll if you have some questions, I guess that's fine. We've got a few we can start off with, I guess, and I'll start off. Maybe we can start on the topic of mortgage payments. You talk about them a good bit in the book, and I guess just start off with, why do you discourage paying off mortgages early?
Sure, it's a great topic to start with as any. So I talk about, I think it's chapter 3 or 4, I go into the premise of when someone comes into, let's say, a windfall or extra cash at the end of a month or a year, it seems to be the knee-jerk reaction at least for a lot of conservative investors or conservative people in general, to throw that money at their mortgage and pay down their mortgage. A similar philosophy might be to refinance their mortgage from a 30-year into a 15-year. I vehemently oppose this way of thinking, as I believe that it goes against the precepts of trying to, first and foremost, inflation has a way of eroding the value of the dollar. And so if you're going to be paying off, using today's money, a mortgage that's going to be naturally eroded over time, you're using expensive money to pay off, or cheap dollars, rather, using, expensive dollars to pay off cheap mortgage. Another reason I feel that this is not a really good philosophy is that you're not taking advantage of, or you're not paying credence, I should say, to opportunity cost. If you're paying down your mortgage, it represents a lack of an abundance mindset, let's say, where you're not being able to take advantage of opportunities out there. For example, cash flow producing assets that can produce many times more of a return than a 3, 4, 5% mortgage. This is all to say that my premise is based on the fact that you are locked into a fixed term mortgage. A lot of folks do have variable arms, let's say, and in those cases, yes, probably the math gets a little bit more complex and nuanced. But in general, most Americans, or most people in general, have fixed 30-year mortgages. And so the notion of putting dollars into paying down or off those mortgages is not taking advantage of other opportunities that can afford you much greater return. So sorry if that's a very long-winded way of saying a number of things, but I welcome any pushback on that opinion if anyone has any.
But you will assume that you will be getting a positive arbitrage from that money that you are investing or reinvesting in something else rather than paying down your mortgage. So it's subject to what is your mortgage rate versus what is the opportunity rate that you could get outside in the investment world. I'm thinking now what rates are that are close to 7%, thinking that you could get something that yield consistently 7%, considering the risk, because of course you can earn more in a passive income rental property or something like that, but you have to leverage that position. So how you handle that in terms of the risk adjusted return versus paying down a mortgage, knowing that one will be certainty and the other one will have different risks than paying down your mortgage? Just curious.
Yes, thank you. Is that Angel? Is that how you pronounce that?
It's Angel, but you could say Angel. That's
And
fine.
Hell, I'm sorry, that's my Americanism
No,
butcher
that's fine.
names. But I'll just quote from my own book here. I've never done this before here, but I say here, I think one of the things that needs to be stated is that I'm making the supposition that most people are locked into low interest rate mortgages right now. So the idea that someone's paying 7% or higher is only if you're locking in a mortgage in the more contemporary environment. The data says, however, that as of September 2024, approximately 62% of homeowners have mortgages with a rate below 4%. And I go on to say that as of September 2024, approximately 23% of homeowners have mortgages with a rate below 3%, which I found rather staggering when I first read it. So a lot of people took advantage of the low rate environment where the Fed was pushing interest rates to zero or slightly above zero, and locked in low interest rates in the twos, high twos at least, threes and beyond. So the idea of being able to arbitrage and take advantage of, say, other opportunities is exceedingly possible in that environment. Yes, as interest rates go up, as is the case, or has been the case in the last, say, year and a half, 2 years, if it's the case that you're in an ARM or you're in a mortgage that's much higher than 4, 5, 6%, yes, the opportunities to arbitrage become progressively more difficult. But that being said, and I make a lot of this points in the book, I'm routinely, I don't want to, again, this is not investment advice, right? So I'll be very careful, deliberate with my words. But let me put it this way: most real estate investors can get significantly higher than 6 or 7% APY, and to the tune of 12, 13, 14% in a well-balanced real estate portfolio, which is what I push very highly in my book.
And that portfolio has leverage. Just
It does. It certainly does.
okay.
So we focus on, when I say we, I mean cash flow investors or real estate investors. The primary metric that we're gauging, the yardstick that we're using, is cash on cash return. So we're not necessarily using return on investment, which is the lexicon used by a lot of financial analysts. Cash on cash return is basically a formula that allows us to say, hey, we're using leverage. So if we're only putting down 15 or 20% into a real estate asset, what cash flow does that generate? You take that annual number and you divide that by the amount of money invested, and you get a number that's usually akin to the 12 to 15% range or higher, depending on the type of real estate assets. For example, short-term rentals will do quite a bit higher than long-term. But we can get in the weeds if you'd like on that. Does that answer your question,
Angel?
Angel?
Yes, yes. But my first, going back to the first metric in terms of building a passive income portfolio, how am I gonna get the resources of the world in order to start building that portfolio of assets? I haven't read your book, sorry. If that's covering your book, sorry, I haven't read it. But that's my first question. If I don't have, well, what am I gonna get the wealth in order to build that passive portfolio, passive income portfolio?
It's a great question. It's probably the question, frankly. And I will be a bad marketer, by the way, if I don't first start with, please do buy the book. I mean, it's fairly cheap. It's on Amazon. You can go to warpwhistles.com. I do answer this question fairly on in the book. But yes, so for someone who has, say, not built up, say, a nest egg or a reservoir of cash, it is somewhat straightforward to get involved in real estate. You can use REITs, for example, which are instruments leveraging equities where you can essentially pool cash. This is a very common way of getting involved in real estate without a lot of cash reserves. The other more traditional way that I'm doing, for example, with a number of my friends, colleagues, and partners, is to pool cash in a way that allows us to buy large assets in the multi-million-dollar equation, but without putting in that amount of money all myself. So I can, for example, take a piece of a pie, 10%, 15%, 20% of a much larger real estate portfolio by pooling it with others. And you can do that through what's called managed funds, which is a very easy way where you take a limited partner role in an asset class. You can also do it with friends, colleagues, and family by forming an LLC and buying, say, multifamily real estate asset. That would be the way that I would do it, and that's the way I've done it in the past traditionally.
But do you consider that really passive? income because you have to put a work and make sure that you have to find a contractor, put up the maintenance, make sure work with the tenants, or you hire a management company to take care of that. How that works in terms to be considered actually passive.
Yes, great question. In all cases, none of the investment that I do am I physically going and plunging toilets or dealing with tenants. I find that the notion of that actually kind of gives me anxiety to think about. So no, I'm always putting a reputable property management company in place, as is anyone I'm investing with, to truly make the environment or the asset passive. And so you have to net out, again, both the mortgage that you're paying on the asset as well as any and all management fees when you determine cash flow. It's going to be net of all of those various cash outlays.
Right. All right. Yeah. Yeah, just a little further on the topic, just, how does, refinancing in a high rate environment impact your approach to mortgages?
That's another good question. I'm not getting some good ones. So when I'm evaluating a real estate asset, for example, I'm always, and this goes right back to the previous sentence I ended with, I'm always evaluating the investment based on its cash flow, based on its net. What am I able to take home at the end of that investment? And sometimes there's a guessing game involved when you're working with, sophisticated products like multifamily investments. You are having to put together what's called pro formas, which is just a fancy Latin way of saying you're an estimate of what of the anticipated revenues and expenses from a real estate investment. But part of that pro forma process is determining what is your mortgage cost in the equation. And that's going to rise in a high rate environment. It's going to lower in a low rate environment. What is fantastic, however, and one of the most lucrative and I'd say coolest things about investing in real estate is because of leverage and because of the nature of, let me just pick on multifamily because it's a space I'm very familiar with. What you can do is you can invest, can pool resources, invest in multifamily, bring rents up to a level that's commensurate with market. And after doing that, go back to the bank and refinance that asset and get some or all of your initial investment back. So a lot of my investments over the last 5 years have been, I've been able to put in a significant amount of money and get 100% of that back within 2 years and continue to get an income stream, a passive income stream in perpetuity after doing that. So these are techniques that equities don't afford you because equities do not allow you to leverage. And again, one of the things I talk about in my book is what do you want to look at when you evaluate apples to apples comparisons across asset classes? Do you have the ability, A, to collateralize? Do you have control of the asset? Do you have the ability to get flexibility and pull the levers when things get rough, when recessions come or when inflation is skyrocketing? A lot of these things you don't have with equities, and that's why, again, I call a lot of them akin to gambling because you do not have that locus of control, but you 100% have that with real estate and other assets. Again, I'm picking on real estate because I'm in that game, but I provide a number of asset classes in the book that I feel are in that camp and allow passive income in a meaningful way.
Yeah. If I could also add to that a little bit, with regard to the mortgage in an inflationary environment, if I were to quiz you and ask any of you, what is the one expense that never moves higher in an inflationary environment and stays fixed? The correct answer to that quiz question would be a mortgage payment. A mortgage payment that's fixed isn't going to rise with inflation. So while your income may be rising with inflation, your mortgage payment is not. And as the dollar is devalued, you essentially pay off your real estate with monopoly money. You essentially get your real estate for free in an inflationary environment, which is why you don't want to pay off that mortgage early, because the longer you could drag it out, the more of a devalued dollar you're paying back that mortgage. The other thing is that it also lends a good lesson in general with regard to fixed debts, not only on real estate, but possibly something like equipment. So, for example, if I had to select between buying stock in a company that is mostly services oriented, which has a high labor component, versus a company that is more machine or industry related, let's say gold or silver mining companies, their costs are more related to their machines than they are to their labor. I realized quickly that the loans that may be fixed rate loans on those pieces of equipment will be just like that mortgage on the house, and that it does not rise with inflationary costs, while their product may be priced higher due to inflation. And so that could result in a higher profit. But for companies that are heavily labor intensive or service intensive, those labor costs will rise with inflation, although they will lag a little bit. They will still rise and may not be as good of an investment. So using these principles with regard to leverage and fixed rate loans in particular, and understanding how an inflationary environment can make such investments better, can yield higher returns overall.
I'll just add to that. Great point, Vikram. I think Warren Buffett, who we all know and love, and much smarter than certainly than me, but he once is quoted as saying that the 30-year mortgage is the best instrument in the world for the casual investor for all the reasons you just articulated. So I found that particularly prescient as we've gone through these ups and downs in inflationary times, that the real estate has held up and passed the test of time.
Yeah.
Right. I did get a question from one of the participants on the chat. Just asked when doing due diligence on multi-family home investments, what do you think are the most important factors to consider?
Cash flow, always cash flow. When in terms of how do I evaluate which ones are going to cash flow the most, that's a much more difficult question, because it really determines, I mean, the old adage being what matters in real estate: location, location, location. There's a lot of truth in that. You're going to find that areas where is a high demand for, or I should say low vacancy rate, is going to do a lot better than buying real estate in the sticks. As a multifamily owner, I want to buy where, in urban areas. I want to buy in areas that have low or at least a moderate amount of crime, as opposed to high amounts of crime for obvious reasons. It scares away, your more casual renter. I also am able to take advantage of, at least here in the United States, I don't know how it works in Puerto Rico, but there's programs that the government actually incentivizes real estate investors like myself by allowing us to take advantage of what's called Section 8 over here, where we get locked in rents at certain income levels, which is fantastic. And a lot of people in my asset class really run away from that. I run right into it. I love it. I can usually get about 30% higher, or at least, I'd say 20 to 30% higher market rate by appealing to Section 8 renters. And the government usually picks up between 80 and 95% of that bill, so I don't have to worry about it. So these are things that I look for. It's just in overall, in a holistic portfolio, risk always plays a role. I'm in no way suggesting any shape or form that real estate is riskless. I think that a lot of times it's easy to say, oh, this is a panacea for all the investing needs. But when evaluating any investment, real estate or otherwise, it's important to look at where does it fit in your overall portfolio? Where does it fit in the wealth pyramid? And again, I'll come back to that. I can articulate that, but I talk about that literally in chapter 1 of my book, which basically describes, if you think of a triangle or a pyramid, you want to be as well protected as possible by putting the majority or the bulk of your assets in the bottom tiers of that pyramid. And I put real estate as one of those class one assets. That means it's stable, it's flexible, it gives you collateral, it gives all the things that I prioritize in my metrics for evaluating investments. And those fit at the bottom of the pyramid. And that's why I want to, when I'm looking at making an investment, I'm figuring out where am I under or over allocated, and that plays a big role in determining whether or not something is good to go in at any given time.
Okay.
If I could, though, I guess I would come back to something that I started with that I think is probably the premise of the book, and it really does permeate all the chapters that I go into, and it's straight out of Kiyosaki, so it's not my own. And I take no credit or merit for the brilliance of this, but the whole formula. So a lot of folks determine their investment schemas based on risk appetite or popularity, which way the wind's flowing, or I should say, or technical analysis. These things do not, to me, enter into my calculations at all, because I'm focusing completely on the rubric of or I should say the formula of how can I make my passive income exceed my monthly expenses. That's the formula that drives everything that I do. And so by that modality am I driving all of my investment decisions. How can I create either more passive income using real estate, using startups, using different managed funds, different asset classes, or how can I reduce my monthly expenses? Because once I've done that, once I've gotten my monthly income to exceed my monthly expenses, then I've reached financial freedom. Then again, if I'm in a W-2 job, I can quit it. If I'm working, I can walk away from that if I so choose, because I no longer have to worry about what Robert Kiyosaki calls the rat race. I can get out of the rat race and live on the mailbox money that those passive incomes afford. What's also really exciting about this philosophy is you're building up a generational wealth, which to me is very important for me and my family. I don't want to just try to build up a nest egg that's, I don't care how high it gets in stocks or other assets, that when I die, or I hope I can get to a point where I retire and don't dwindle them away before I die, so I can pass on something to my daughter and the rest of my family. I want to have something that's going to be an actual engine that's going to be driving well after I'm gone and well after my children are gone. So that's going to be carrying over from generation to generation. And you can't do that in equities, frankly. You cannot do that by building up, unless you get to a level that's so beyond anything that at least I've, and many people in, say, white collar America are able to achieve. You cannot get that level of wealth through 401ks or other equities. You can only do that through passive income generation.
Let me just sort of follow up there a little bit. You mentioned your pyramid. How does your pyramid concept work for low-income investors, given that low-income investors often lack access to foundational assets like real estate?
Yes, well, it's a great question. I think the question of how do low-income investors get involved in any investment is always going to be the challenge. I mean, when you're low income, you're dealing with a limited number of economic resources by definition. What I do talk about, I think it's chapter 3 in my book, is that a lot of low income folks need to be focusing on the true, say, block and tackle that's necessary to keep, for their investment paradigm. And by that, I mean getting out of debt, right, is probably the most important thing that a low-income individual can do. Usually the reason someone's low income is because they haven't yet mastered financial literacy and haven't learned to budget, haven't learned to do the things that are needed to get themselves out of debt and build wealth. Because once you can get out of debt, then you can start following other principles and practices like are espoused by the richest man in Babylon talks a lot about paying yourself first. And some of these philosophies are about, for example, putting 10, 15% away every single paycheck. Pay yourself first before you go and pay your expenses. And using this sort of framework allows you to build up a cash reserve that you can then use to invest.
I can add to that as well. One of the nonprofit type activities that I engage in is I visit the orphanage, the San Juan orphanage that is near the Sheraton Hotel, near T-Mobile, Distrito T-Mobile. And over there at that orphanage, I've taught a basic mnemonic. I call it SIT large, SITLG. And basically, what I'm teaching those kids is before you can even envision coming out of a low income situation through investment, the first thing you got to do is S, which is learn to save and put away your money. And Sean, what you just said, which is pay yourself first and some kind of savings investment, is a great idea. Other ideas I've heard are to have 52 envelopes, each representing an envelope for the week, and you can have various dollar amounts listed on that envelope, and you do the same basic thing as you put those dollars into the marked envelope each week, and then the rest of the money that you make is for your expenses. So therefore, S is saving, and it's super important. Then you can move on to I, which is investing. T is to mind your taxes, but minding your taxes doesn't just mean trying to reduce your taxes, but also understanding the tax code, because the tax code gives everybody an insight into the things to invest in. I mean, do you want to have passive income? Well, the tax code talks about how passive income is taxed. And so you get a sense of the kinds of things that you should be doing if you understand taxes. L is leverage. And effective use of leverage means knowing what to take loans out on. And generally speaking, I mean, you could listen to Dave Ramsey, but as a general rule, things that appreciate, you can take a loan on. For example, your mortgage on a house, your house is expected to appreciate. A student loan, if it is in a degree that's going to give you appreciation in your professional life, that's something you could take a loan out on. But consumer debt, no, because consumer items that you charge on your credit card depreciate, they don't appreciate. A business, yes. A car loan, probably not. You might want to buy the car in cash because a car depreciates. And then G is this idea of globalizing. So what that means is if you get to a point where you have enough money to start a business, you're going to need to find ideas for your business. And some of the best ideas you steal. And by that, I mean, for example, Starbucks CEO Schultz went to Italy and saw coffee shops there. And he said, there aren't any coffee shops in America. And he brought them over to America, stole the idea. So by being global, by traveling, you can look for ideas elsewhere that don't exist where you currently live and steal the ideas. Now, what he also did as a side note is he tried to mimic it exactly, piping in opera music into the first Starbucks restaurants. And Americans said they didn't like the opera music and would prefer their own music, which brought about the idea of, well, why don't we have Wi-Fi at Starbucks so that people could listen to the music they want to listen to? And that started a whole revolution where now you've got Wi-Fi in a lot of different restaurants. So sometimes that's all it takes. And so that's what I teach at the orphanage, sit large, and it's easy to remember, but it addresses a low income situation. You know, you can't just assume you can start investing. You got to save first.
Yeah. And one thing I wanted to add was in chapter 9, you argued taxes are the toll roads to wealth. Most people pay full price, but the savvy find better routes. Aren't these better routes like unaccessible to maybe normal people or people who are starting out or people who find themselves in a windfall? And can you describe these the better routes better?
Absolutely. And thank you for quoting my book. That really gives me the warm fuzzies. I appreciate it. Yes, it's a great question because actually, I'll kind of follow up on both what you're both saying here is a lot of these concepts that we're talking about today and I talk about in the book are not just, hey, I picked up this book and now I read through it or I got to chapter 9 and now I can take advantage of all these tomorrow. I think I liken it to going to the gym. You know, you walk into the gym, if you've never worked out before, you're not going to be able to bench press 225. It's just impossible. It's as far away as you know, tap dancing on the moon. So you're not going to be able to achieve that day one. But what you can do is you can work up, you know, build those financial muscles by getting into things that you can do. And so chapter 9, Lorenzo, is again with tax strategies. You're absolutely right. Someone low income, someone that doesn't have the money, hasn't been doing investing, is not going to be able to take care of or take advantage of probably any of the strategies that I outline in that book because they're just not there yet. That's like trying to bench press 225 when they've never stepped foot in the gym. But someone who has been investing for their, you know, many, you know, years or decades is going to be able to take advantage. And so you do kind of have, and the reason I wrote it and didn't start with chapter 9, you know, chapter 9 is near the end, is because you're going to be building upon these concepts as you go forward. So again, when it comes down to low income individuals or folks that just don't have the means to really do substantial you know, investing schemas, again, I really would say you got to build from the very beginning and then work your way up. And so, you know, it might be the Dave Ramsey strategy of putting cash in envelopes, and that might be the place where you're at, and taking advantage of his baby steps that he talks about, at least the first three. Actually, I really stray far afield of Dave Ramsey after his first three baby steps personally. But you know, that might be where certainly paying yourself first and reading a book like Richest Man in Babylon. These are tools and techniques that are going to help anybody, but they're certainly going to meet you where you're at when you're starting your journey. And then as you build on that, after you've gotten these practices down, after you've been budgeting for a year and a half, 2 years, and you have your income streams and you have your expenses and you know, and you have a pool of income or of cash sitting there you want to take advantage of and deploy, then you go to the next chapter, or then you go to the next framework that you can take advantage of, and then you start building your asset classes. You start building your passive income streams, and then after you get beyond that level, now you've got maybe a real estate asset under your belt. Then you jump to chapter 9. Then you can take advantage of, for example, cost segregation studies and accelerated depreciation. But you're not going to get that until you've kind of worked your way there.
Mm-hmm. Thank you.
All right. We did get another text question from the audience, and someone who has read your book, but he wants to get your views on you know, how to leverage whole life insurance. So you talk about that a little bit.
Just generally, or is there anything specific about leveraging whole life? Because this is a topic, guys, I could talk about. In fact, as a quick aside, by the way, I didn't get into this, but the reason I wrote this book is not just because I had time to kill and I thought I'd just write a book. You know, there's a level of financial literacy that is so important to me and several friends that I have, and we started getting together and talking through a lot of these concepts. How do we invest? How do we deploy our money? Where does our money sit when it's not deployed? You know, and I'll talk about that in a second in whole life insurance. But as we started meeting, you know, we realized that we could expand the scope of these conversations, and we could certainly expand the number of people taking part in those conversations. And before we knew it, we had a group of about 25, 30 people meeting in my basement once a month. And we would have really lengthy conversations. And what would come about from these conversations was, what books do we need to read? How do we foster our financial literacy? Because it's so important. It's like going to the gym. That's pumping iron is reading on this stuff and getting involved. And so, you know, the question of what books do we read came up almost every meeting. And I would throw out, and my friends and colleagues would throw out, oh, this book and that book and that book. And, oh, you haven't read that book. Oh, you haven't read this book. Oh, what are you thinking? So finally, I think someone stood up and was like, Sean, I can't read 26 books. Which book do you recommend and why? You know, it was tongue in cheek, but it was coming from a good place. And I looked him in the eye and I said, well, I can't recommend just one book. So you know what? I'll write the book that you need to read. So my book is basically a distillation of far smarter people than I am. Very, very smart financial gurus from, again, Dave Ramsey's in there, Tom Wheelwright, Robert Kiyosaki, very smart people who have very smart ideas about a number of financial topics and investment schemas. So I am building, I'm standing on the shoulders of geniuses is what I'm basically trying to say. So I hope that gets across, is that this isn't just Sean Dempsey's manifesto of how to invest. I'm actually leaning on people that are very, very accomplished and bring a lot to the table. All right, so that sidebar out of the way, the question was about whole life insurance. So one of the chapters, I think it's chapter 4 or 5 in the book, I do explain that money needs to be moving at all times, at least when it comes to a banking system or when it comes to your own personal finances. If money is not in use, it's stagnating. And so the question often comes is, what do we do with the money that's not deployed, that's not in a real estate asset, that's not in equities, that's not in crypto? Again, I put that more in the speculative bucket, but what happens to your money when it's just sitting there? Let's say you sold you had a big real estate transaction. Now you're sitting on some money. Is it best to keep that in cash? Do you put it, commodities? What do you do with it? Bonds? And after, again, a significant amount of reading on this topic and a lot of frameworks analyzed, and I say we, I mean colleagues and friends, have come to really identify what what is called the infinite banking concept as the best place to store wealth when it's not in use. And what you do is you're leveraging or employing whole life insurance policies as a storehouse for your wealth. And it's one of the best asset classes for stagnant money because it's money that's going in tax-free and it's treated with all the tax benefits as a Roth IRA. So it's growing tax-free, which means that any appreciation on the gains, and it usually grows between 5 and 6.5% every year, is 100% tax-free. You can access that without any taxes. There's no taxable event to access that money when done correctly, and there's some nuance there. And it also is not restricted like a Roth 401k, or excuse me, I said Roth 401k, I meant Roth IRA. It's not restricted like a Roth IRA in the limits. A lot of folks are unable, probably in this group, I would imagine very, very few people have the ability to contribute to a Roth because of income limits that are placed in place. I mean, even if you do not hit those income limits, you can only contribute, I think, up to like $7,500 a year. So if there's a place to store those dollars that are going to grow tax-free, and you'll have 100% access to those dollars that you can deploy on investments without actually breaking the compound interest curve, that allows you to kind of have your cake and eat it too. And so we employ whole life insurance for that reason, to store cash until we go and use it on a real estate investment or other asset. It's a long-winded way of saying read the book, because I'm not going to be able to communicate everything all the nuances involved in IBC in a meeting like this. But I do go into great detail in the book, and I encourage anyone to read it who wants to learn about infinite banking and or whole life insurance.
All right. Do we have any follow-up on that topic or from anyone? All right. Well, I'll move on to let's talk about the traditional financial management. And I think in your book you challenge a lot of the traditional wisdom. Just start off with what's the most harmful piece of traditional financial advice out there, in your opinion?
That you need to delegate the responsibility of financial management to someone else. I think that is quote unquote normal for 90, I don't know what the percentage is, 90+% of people. They do not like money. They get anxious about it. They just don't want to deal with it. And so they're very happy. I hope I'm not stepping anyone's toes here who are financial planners, but they're happy to abdicate the role of financial management to a financial planner or a CPA or someone that gets to deal with their money. I believe very strongly in keeping the role of one's financial destiny in your house, in house or inside your family, so that you can control and deploy cash. Because frankly, no one cares about you like you do, and you don't want to wake up 40 years down the road, um, you know, hoping that your money is there and then finding it's not. So the best way to avoid that is by taking control of your own financial future.
Right. We have any, ask anybody else in the audience, have any other questions?
Now, my other question will be, counter comment to your recent comment. It's like sometimes when you're dealing with your money, you have emotion attached to that money that someone else may not have, and be more, we'll say, will have less biases in terms of managing that money and doing the right things. Yes. We're assuming that that person is having a fiduciary role and acting on your best interest, rather than someone, buying real estate and then hearing that there may be a crisis simmering in real estate, and it may have nothing related to it. Maybe be equity offices that is a multifamily, but still, get worried, get anxious, and make bad decisions. Like, people usually sell the stock market when it's down and buy when it's up. So usually that type of things may bias your rationale and make you make bad decisions. That's what I think sometimes it's good to have someone outside that, be more objective and more rational when dealing with managing your money.
That's a fantastic counterpoint. I will not disagree one bit with what you just said. I think the lens that you're viewing that with is one of the equities, primarily. When you think about money management in today's society, you're usually thinking about a money manager who's handling someone's IRA or their brokerage portfolio, for example. Again, this is not the way that I typically think about investing personally. And again, I wrote a book about it, so I obviously am highly one-sided on this topic. I'm happy. I enjoy the debate and I welcome it. But when I think about investing, it's not sitting around managing a portfolio of stocks. To me, it's managing a portfolio of assets. And those assets should be cash flow producing. If you're not focused on cash flow producing assets, then you're not ascribing to the formula of wealth that I outlined earlier, which again is passive income is greater than your monthly expenses. If your stock portfolio is not generating passive income, then frankly, I don't think of it as an investment. And that's a very controversial topic. And I outline what I define as an investment in the book, and it's something that is passive and will throw off dividend. They could be things that throw off dividends. It can be things that throwing out off rent. It can be coupon payments from a bond. It can be guaranteed payments from a business, small or large. But it's not growth stocks. It's not a Kathy Wood's portfolio. It's not a Tesla. It's not a Bitcoin. So sometimes it's easier to find what I'm talking about by saying what it's not. And these are, I'm not saying there's no good or bad. There's no stratification of this is a good investment and this is bad. I'm not saying that. I'm just saying that as you're defining terms, speculation needs to be in its own camp and its own way of thinking, and then investing needs to be in a separate one. And that's why I don't think about stock portfolios as investing for that reason. I think of them as speculating, by and large.
I'd like to add a little bit to that. The thing about growth stocks in general is that the expectation is the dividend will come sometime far into the future as opposed to now. And you could try to use some sort of a dividend model to try to determine what the price, the fair price, or the valuation of that stock is by discounting that very far future dividend. But the problem is that with a lot of the growth stocks out there, like a Meta, formerly Facebook, there's really no way to even estimate, or a Tesla, what that future dividend is going to look like, especially if you say Tesla's not a car company, it's a data mining company. Or if you say Facebook is not an advertising company, it's a whole different kind of a company, right? So becomes very difficult to estimate that far end dividend. And so it becomes more speculative. But more importantly than even all of that is that if we are entering into an inflationary era, then those far future dividends in a growth stock that have yet to materialize will be worth a lot less in that future time if you take into account inflation. Inflation will diminish that, will basically turn that into monopoly money, that future dividend. So it could devalue the value of your stock in present value terms when you consider that. So that's why I agree with Sean that a dividend paying stock makes a lot more sense because you could value it more immediately because it's closer to you than a growth stock where the dividend is far away and it's harder to value it and discount it. One thing I also want to add is on the point of having a financial advisor. The issue there is that, of course, the person has to know themselves. Warren Buffett says, don't fall in love with any one stock. So if you're the type of person that falls in love with stocks, and you see this in the crypto community where people fall in love with a particular cryptocurrency, they might be a Bitcoin maximalist or a particular flavor of crypto that they like. But they have no idea how to value it or how to tell you without pulling a number out of a hat, they couldn't tell you what Bitcoin's value is going to be next year. So, so for those kinds of people who need somebody that can be more disciplined in terms of diversifying, and can understand their time horizons and their risk aversions, a financial advisor may be helpful. But I do tend to agree with Sean on this in that a financial advisor is kind of expensive for what they're doing. They usually charge 1 to 2% of an account, and that ends up eroding the returns on that portfolio over time. Every single year, you're pulling away 1 or 2% from that portfolio. And in the end, it starts to equal the same as investing in an index fund or an ETF. And so then the question becomes, well, where is the value then if you can get the same exact return with an ETF? So these are the kinds of things that probably should be thought of when it comes to financial advisors.
Hey, I have a couple questions for Sean if the floor is open.
Sure.
So I've come across a peer-to-peer website that I think is pretty cool. It's related to real estate. It's called Ground Floor. Have you heard of that?
Sounds familiar, but not.
Groundfloor.us. And I think it's a pretty good website in terms of getting things that are paying cash flow. And it also, I think it helps people who want to get into real estate become educated because you're seeing different projects. Basically, it's a fix and flip type website where you're doing the financing. You're helping finance some of these things. So I wanted to know if you know it. Obviously, you don't. Just curious what you thought of it. But I also wanted to know if you had any thoughts on different learning or analytical tools on the internet. And I'll give you an example of one that I think is pretty good. And it's a portfolio visualizer where you can sort of set up your portfolio and see how it grows into the future. I was just wondering from your perspective, what websites or tools people could use to learn about what you're espousing.
Yeah, thank you for that question. So I wasn't familiar with that particular one, but there are a number of aggregation-based websites out there for pooling money. I think that the common tagline is you can invest in real estate for as less as $100 or $200
Yeah,
or whatever.
Yeah.
Those are very common. And again, there's nothing wrong with that. And I think to go back to a previous question, that might be a way of dipping your toe in the real estate
Yes.
market with not a significant amount of money. The problem with those services, and this is true of REITs as well, is you're not able to take advantage of collateralization, which is one of the most significant value adds for getting involved in real estate. And you're not able to take advantage, usually, though this is not always the case, of depreciation. Tom Wheelwright calls depreciation the magic expense because it is it's something that you just get to write off your books without really having to do anything. And when you invest in real estate, certainly with cost segregation rules that are out there and such as bonus depreciation, you can write off a significant amount of your investment in the first year that you invest. And that's, again, one of the reasons and one of the tax strategies I talk about in the book that you just can't do with some of those tools that you just described. So I'm not in any way suggesting not to use them. I'm just saying that there is other ancillary benefits of getting involved either directly or in pooling resources through a managed fund or a LLC that you can allow you to take advantage of those two benefits of real estate. There's a reason why, by the way, the tax code's about, I think it was like 1,500 pages long, and the explanation of what your income is only the first like 4 or 5 pages. The rest of it's all about how to avoid paying that tax through means like real estate. So real estate is a fantastic way of taking advantage of the tax code, which again is another real reason that I use it. In terms of the question of what software I'm using, I really like a great piece of software called Visor, BYZER.co. It's you can get involved free. I can provide a link in the notes or something. But it allows you to track your entire portfolio, both stocks, equities, real estate, managed funds, whole life, everything, and analyze it at an aggregate. How is it doing year over year, month over month? If and when there are expected cash flows, it reminds you. You'll be looking for them. If they don't come, then you get alerted, which is really good for cash flow investors like myself. And then one of the great perks of that software is since it aggregates thousands of people's portfolios in an anonymous way, it shows you which products out there or which funds, which asset classes consistently provide the best returns for its customers, which has been really valuable to me. You're on mute.
What was it called? You put it in the chat, or did you?
I'll put it in the chat right now. It's called Visor, VYZER.co. And actually, I have a link you can use to sign up that will get you, I think, a free month or something like that.
Yeah.
Mm-hmm.
Thank you.
Yeah, no problem. Does that answer your question? I hopefully.
Yep. Yeah, you're good. Yeah.
Okay.
All right. Got another question through the chat here, Sean. Just one. What are your thoughts on farmland as an asset?
I think farmland can be a good asset for the tax strategies that it allows. I don't personally own any farmland because it's not cash flow producing, but it can be an advantageous thing to do. So I think it's a good thing that now we're getting to like invest. We're talking about investing 101. Let's say we're graduating to investing 201. I don't personally ascribe to investing in something just for the tax benefits. I don't often do that. Unless it is knock your socks off kind of thing. An example of that is I did do, even though I'm talking on both sides of my mouth, but I realized I found recently through an agency you can invest in a movie production and you get 4 times the amount of your investment back to you as a tax benefit. So you get to write off 4x your investment against active income, which to me was a deal pretty good. I couldn't pass it up. But by and large, with that one exception, I don't usually invest in asset classes that just for the tax benefit. It's for the cash flow that, again, because repeat myself, I'm looking for cash flow to equal or exceed my monthly expenses. That's my whole modus operandi.
And just following up on something you said there, I guess another question from the chat, but in your book, you do an honest review of your investment performance. Just wondering if you have any updates you can share with us.
Yes. So, that's one of the things I just to toot my own horn. I've never seen in any other book. I've probably read 100 plus financial tomes over the years. And this is the first one, my book, where I actually go in great detail and with specific numbers through about 2 years, 24 months worth of investing that I've personally done. So I'm trying to, the point of those chapters was essentially to say, hey, I'm drinking my own Kool-Aid here. I'm practicing what I preach. We talked about it. Here's what I'm doing. And now here's what I'm doing that employs these philosophies. So I have at the very end of my book, a pretty detailed analysis of the investments that I do in things like real estate, BRRRRs, multifamily, short-term rentals, managed funds. I invested in a lobster boat a couple of years ago. So that's bringing in passive income because an operator basically is out there every day bringing lobster out of the water. So I am diversifying my portfolio, but in a very different way than a traditional investor might do with a stock portfolio. So I guess, Joe, to answer your question, what updates I had. So one of the investments I made in 2023 was in an ATM fund, which basically means you put money in. It's available for accredited investors only. You put money in, and then you get a passive, check every single month for about 10 years. Unfortunately, and this is something that you run the risk of when you do speculative things, and I put this clearly in tier 4, which is at the top of the risk pyramid. So I do make it very clear that that's what that investment schema was. But it did turn out that an operator who was running this $460 million fund wound getting a little fast and loose with the acquisitions it was making. So it run afoul of some of the distributions that it scheduled that it was supposed to make, and wound up getting sued by the fund managers. And I ended the chapter there when I was talking about that in my book. The update to that is that they did make a buyout offer to the investors. They were not able to satisfy that in time. And so they had a judgment outlined against them that basically provided the entire ATM network to the fund management company. I guess we're getting in the weeds on that one, but that would be if you have read the book, that's kind of a little plot twist that I kind of put at the end, which I hopefully was going to write a follow-up about if I ever get time to do so. But it does I guess the macro level takeaway here is that even though I am investing in passive real estate, passive investment schemas, and I would put them very clearly, the 99% of my portfolio is very safe. It's very liquid, or excuse me, I should say, it's very predictable and stable. I do also fall victim to FOMO. I think Stephen Ingles was asking me a question just yesterday, and that's always going to play a role in anyone's investment philosophy. And so when you do get those moments of FOMO, you gamble. When if you have the ability and you've structured your pyramid correctly, there's no reason you can't throw a couple dollars or a couple $100, depending on how much money you have, at something that hot tip that you get, that crypto or that Bitcoin or that fun thing. And so I think that's part of the fun of investing. As long as you're well stabilized, as long as you have a good stable portfolio, you can take that occasional gamble. Because when it does hit, you hit big. But when it doesn't, you got to be prepared to take your lumps as well. And I took my lumps on that one, and I'm better for it. I learned from it. So, but I didn't gamble my entire portfolio on that ATM managed fund. I gambled about 5% or 4.5%. So it was like, yes, it did not pan out the way I wanted, but I think that again, 95% of my portfolio is very well structured, and I don't need to worry about that with the rest.
All right. Well, I think we're kind of running up against the end of our time. I'd like to thank you, Sean, for spending the time with us, and like to encourage everyone to buy Sean's book. And you have any.
Go to Warp Whistles. That's 2 words or 1 word. Warpwhistles.com. That will bring you right to the Amazon page. And I guess I'll end with, for those who haven't read it, it may seem like an odd title. I didn't really get into this, but it's based on a video game where you can basically catapult yourself to later levels in the game by taking these warp whistles. And it's an analogy for life and investing. Is most normal people play the game 1 level at a time. I'm encouraging my readers to blow these rhetorical warp whistles and get ahead in the game and the chapters that I outline hopefully get them there. So if you're interested, check it out. If you have any other follow-up questions, please contact me directly. I'd be happy to have a one-on-one or any sort of dialogue in social media or any other format that people would like.
Well, I don't think I can let you get away without telling us what your high score was.
Unfortunately, the game was Mario 3, so there was no scores. You just kind of win the game or you don't. So.
Okay. Shows how much I know. All right. Well, thank you again. And,
thank you very much. I appreciate it.
Thank you.
All right. Thanks everyone for joining us.
Thank you all.
Thank you.
Thank you.